Kitco Mining special coverage of Xplor is brought to you by Radisson Mining.
You're watching Kitco Mining's ongoing coverage of Xplor 2025 in Montreal. Joining me now is Michael Gentile, founding partner of Bastion Asset Management and longtime mining investor and board member. Michael, welcome.
Good to see you again, Ernest.
So here we are again. Last year, we had the metals surging, and you were telling us that this is where we were in the cycle. The majors were going to take off, and this was ultimately going to benefit the junior mining. Now, here we are. Metals and the majors have made huge gains this year, and it's a very different environment for junior miners. So we're going to get to that relationship in a little bit. I wanted to start with the metals because the metals have also been very exciting recently. So we've seen, once again, an incredible run-up in gold prices. We're now trading on both sides of $4,000 per ounce, which was unheard of even last year, never mind a few years ago, when 2,000 was the high watermark for a very long time. So we have some people saying that 4,500, even 5,000, a lot of investment banks are pointing to, and not too long, maybe a year and a half. We have other people saying that this is the top, that we shouldn't really expect any further gains from gold, and nothing significant anyway. What's your take on the gold bull market right now?
Yeah, I think what's different this cycle versus other, and this has been the central bank buying. We've talked about this in previous interviews, but we've had consistent central bank buying for the last several years. True physical demand, which we haven't seen in probably 50, 60 years in the gold market. And so what's changed in the last year was finally, in the last, let's say, 6 months, we've seen the traditional financial demand come back alongside the physical demand. So first of all, I think this gold trend is different than previous cycles because it's a longer-term, stickier money, which is central bank reallocation away from the US dollar into physical gold demand. That's a real physical bid. The previous rallies, you've seen gold rip higher and then pull back quickly. It's been really financially minded investors or more trading-oriented hedge funds, big macro entities that are, buy at 2,000 and sell 3,000 or, lock in a 50% profit. So you have this really strong physical bid from central banks under the market. And the last, let's say, $500, $700 has really been the investor demand that's come alongside physical demand. We haven't had that in a very, very long time. Both physical demand from central banks and then investor demand. So that's what's really been driving the gold price. I continue to believe that gold's a mega trend. We've talked about, US dollar rotation, too many deficits, too much debt, dollar devaluation. I don't see anything right now to upset that apple cart in terms of, longer term structural demand. You mentioned earlier before talking, $100 move in gold is a lot less on a percentage basis than it was when gold was $50, $100. So we're probably going to see more volatility in terms of dollar moves, smaller on a percentage basis. But I do really think we're in a very long-term structural bull market for gold. We're not going to see $500,000 per ounce moves every 6 months. But I do think the trend is your friend here, and we have a due structural backdrop for gold going forward is very, very positive. I'd also say I'd look at investor adoption generally. So 2 or 3 years ago, I looked at the stats, 0.5% of total wealth invested in all things in the world, real estate, equities, bonds, was in gold. If you double the gold price and you assume some more allocation to gold of investor portfolios, maybe we're at 2.5% of total wealth allocated to gold and precious metal equities right now globally. That still strikes me as a very small number compared to 25% of central bank balance sheets now being gold. So the smart money, the guys that print money for a living, have 25% of the reserves in gold.
25% and rising.
Rising. And the average investor has 2.5% in gold. So that does not strike me as overextended. We live in a world where 5 or 10% of total invested portfolios are allocated to gold and gold equities. I think that's a very fair and rational thought. So we've got a lot of room to go from an adoption standpoint as well. And that's what you want to see, this rapidly broadening out to family offices, non-traditional buyers of gold. You're starting to see interest from them. They're not buying yet, but they're starting to ask questions. I'm getting those questions when I do travel the roads interviews. So I think we're still very early in that adoption cycle as well.
That's interesting because do you think that the investment community has caught on to this long-term trend of central bank buying, providing a floor to the price? So in the past, you have people get into gold for different reasons, inflation, worries about currencies, geopolitical events. They get into gold strategically. It's a short or medium-term move, and then they get out again, and gold comes back down. We're seeing a long-term trend of central banks just building up their gold reserves. So they're buying steadily. They're not selling. They're not planning to sell. They're not selling in a year. They're not selling in 5 years. They're not doing this for a 5-year plan. This is a long-term. So how does that change the picture? Often what we talk about is what's happening or what should happen, and have people caught on to it yet?
It's a great point. I think the previous buying of gold was more renting it. Investors are renting gold for a thematic, for a period of uncertainty or a period of money printing we saw during COVID.
Right, like a lockbox for value, short term.
Short term, 6 months, but they're buying it at $2,500 and they're like, well, full $3,500, I probably should take my money off the table. Where the central banks are owners of gold. And a central bank that bought gold at $2,500 last year is not saying, well, it's $3,900 now, we should take a bet off the table, I got to get my numbers up for next year, or performance fee, whatever you want to do. They're owning it as a structural allocation. And they have a percentage target, which they don't disclose to us, obviously, but they have a percentage target of their reserves they want to have in gold. So that's really the point where they might stop buying or maybe sell some if it goes past that target. But it's a very clear trend that the treasuries continue to be sold and gold continues to be bought. So we don't think that rotation is done. And you're right, those buyers are not price sensitive and they're not trading around it. So you have this firm owner demand in gold you haven't had for 50, 60 years. And then you have the traders and the investors that will take profits, and that's what's going to keep some of the volatility on the margin. But that trend, I think, is very sustainable. And it's a new dynamic in the gold market. So I don't think the average investor has caught on to that. Even the equity investors are still in that renter mentality. And when they move to, let's talk about that 2.5% goes to 5-10%. Do we get to a place where the investors have an ownership mentality of gold as well? Say, this can be a permanent fixture in my portfolio. So I can no longer trust the 10, 30-year bonds of most G7 countries. That fiat currency is not going to be really valuable when they're paying me back in 5 or 10 or 30 years. So I need to have a fixture of gold in my portfolio. That's where I think the market is going. The central banks are telling you where they're going. When mainstream goes to that, you're going to see better valuations and less volatility and more sticky ownership interest in this sector.
But it's interesting that even with investors coming and going and treating it more or less the way they did, say, 10 years ago, the pullbacks are much smaller because they're a less significant part of the overall. Even when they come in or when they leave, they're not driving the market the way they would have in the past. And we'll talk a little bit about the impact of the long-term uptrend in gold prices on mining as well. But I wanted to ask you about silver, because silver has been potentially the most disrupted of all of these. So gold is a steady uptrend. It's disruptive in the sense that it's structurally bullish in ways that it potentially hasn't been in decades. Silver has been potentially the most messed with of the metals this year. So we have unprecedented supply disruptions on the physical supply. Some of this was based on the tariff announcements or threats of tariffs, on clarity surrounding tariffs. Then we also have the possibility of it being listed as a critical mineral by the United States. So we can see reasons why silver should go much, much higher and should be much more in demand. We can also see market reasons why silver could spike and could sell off based on these types of more political or policy-based drivers. So how do you see the risk reward for silver, the silver market as a whole, right now?
Yeah, I think on silver, people kind of twist themselves into knots. Is it a monetary metal? Is it a base metal? Is it a strategic metal? Is it driven by supply demand, driven by monetary demand? I have a more simplistic, but I think a pretty accurate view of the silver market. If you believe that precious metals are going mainstream, if you believe that generalist adoption, if you believe that 2.5% is going to 5 to 10%, then silver is going to be a very good investment. And why do I say that? Is silver for me is an excellent proxy of retail, non-traditional, non-central bank buying of precious metals. If you look at the correlation between silver and junior precious metal miners, it's very, very high. It's a proxy for retail interest. It's a proxy for general public interest in precious metals. And so that's, to me, is the biggest driver of silver prices, despite critical metals talk and supply-demand talk and solar and applications, or it's a monetary metal. The reality is if you're a central bank and you want to stack silver to hedge against US dollar devaluation, you would need 100 football fields full of vaults to store enough silver to make it actually monetarily viable. So it's never really going to be a central bank monetary metal. But if the gold and precious metals trade goes mainstream, the average retail investor, the average family office can get their heads around silver. And because silver is a much smaller market, it has these dramatic price moves when larger amounts of money start to come into a smaller market. So I really think if you see if we're right about gold, that gold's going to take a bigger and bigger portion of investor allocation portfolio, silver should do really well. I get the question on silver to gold ratio all the time, and when's it going to collapse? Again, I said if more and more investors are allocating to gold, non-traditional investors, that ratio will collapse because that money coming in the sector has to find a home, and the silver market's very, very small. When sentiment is weak, silver has wild swings down. It's a triple levered or 4-time levered beta play on precious metals. And so really you got to get your sentiment call right and your outlook call right, and silver will do very well. twisting yourself with the knots about critical metals, supply demand. It doesn't really drive the price as much as is there money flowing in the precious metal cycle or not. That's what really you see happening. And that's why silver has been so strong the last 6 months, because the retail markets just woke up again to precious metal junior equities and mining investment. And lo and behold, silver has done really, really well. There's a very strong correlation between those two things.
Right. And then I've heard some analysts are kind of throwing the gold-silver ratio out the window in terms of its predictive value, because they're saying, yes, I mean, we can look and we can say silver is very undervalued relative to gold. But what you said earlier is also true. You have this long-term bid underneath gold from central banks, which you're not going to have under silver. So it doesn't mean that. So the opportunity, the volatility in silver could potentially be even more extreme than it was in the past, and it was extreme enough because you had this mirroring volatility to a degree in gold. You had people pouring into gold, people exiting gold. So gold could go way up and way down. Silver could exaggerate even those moves, being a smaller market, playing catch up and so on. Now you're going to have less volatility in gold, but you could have just as much or more volatility in silver when all that money gets into the silver market, because it has to, the retail money. But then they're also going to be exiting because silver is going to be smaller market with more volatility. But gold is not. The gold-silver ratio, there's no reason for it to follow historical trends if you have this quasi-permanent bid underneath gold that won't be there for silver, even in 10 years.
If the move from $2,000 gold to $3,500 gold, mainly with central bank buying, central banks don't buy silver.
Right.
So it makes perfect sense to me why silver would dramatically have underperformed in that environment. The previous 10 cycles, before the monetary gold standard was removed in the 70s, was all financial demand. So it made a lot of sense that gold and silver would trade in unison, because when investor money was coming in, financial money, that was the only money coming into the space. And that was money would flow both to gold and silver. So you're right. What I'm saying is when the financial money starts to come into the sector, silver will outperform. And you're also right. When that money comes out, it's going to have more exposure because it's not going to have that physical bid. You talked about gold having less steep pullbacks. Well, because when gold pulls back, you have a physical bid you didn't have before to take advantage of the price pullback, right? There's less of that in the silver market. So yes, it should be more volatile, more upside, but much more volatile than gold going forward. But if it gets mainstream, silver will do very well.
Right. It's very interesting. It's what you use to calculate the value of silver that's getting more and more difficult.
Yes.
Then the traditional valuations aren't necessarily there. Now I also wanted to talk to you a little bit about copper, because some of the things that have impacted silver are impacting copper, but there's just a lot more copper. It's a lot less sexy potentially as a metal. People aren't looking at it the same way, but we have this pivot from things being very focused on electrification and green energy a year ago for silver and copper, among others, to now it's much more about are you securing your national supply chain? Are you in a position to have a supply chain for your defense industry, for AI, which is defense at this point, among other things, for power, for your infrastructure long term? So it's not a critical mineral on the one hand, but it's absolutely critical to all of these critical applications at the national level. So how has the picture changed for copper and potentially for copper producers with this redirection towards more of a national security, national interests focus as opposed to green energy?
Yeah, I mean, I think AI is going to be a massive power consumer. So the power grid is going to be extremely strained to supply AI. So copper is a direct beneficiary of that. What's changed in the last 3 to 6 months, Ernest, has been the guys that do big macro work in the space, myself included, have an undeniable view that copper supply demand is going to get more and more into deficit as you go farther out in time, because the mines take a long time to come on. The demand is consistently rising. We don't have the supply to meet that demand. So the long-term backdrop for copper was very strong. But the last 2-3 years, you had a lot of uncertainty in the economy. So near-term demand was clouded by tariffs and economic weakness and slow economic growth globally. And also the near-term supply demand was more in balance than the longer-term supply demand, where there was big deficits. We had Ivanhoe in the DRC, and we had Freeport, one of the biggest copper mines in the world, Indonesia, both have major supply disruptions, which has instantly tightened the copper market to put a deficit both in the short term and the long term. So now investors looking out saying, well, 5 years from now, we're drastically short copper. And right now, we're short copper. So that's why copper is making new all-time highs. And to your point, governments are banging in the drums, which are catching a larger audience and saying, hey, do we have a problem in copper? Why are so many governments talking about copper? So that's drawing more journalists' attention and more validation of the fact that we need to secure this longer term. So I think it's the perfect storm for copper now, in the sense that we've had both the short term and the long term lining up at the same time. Whereas before, people were worried about the short term but loved the long term. So that's why copper is making new highs. I also think that you need much higher copper prices, even beyond $5, to justify the capital on copper projects. Copper projects are much, much bigger than gold projects in terms of capital, complexity, multi-billion, $5 to $10 billion projects sometimes. So if you're a big major mining company like a Teck or a Vale or a Rio, you need to have a big margin of safety on your copper price to justify that multi-year, multi-billion dollar investment. So the price signal has to be higher as well. And that's also in the background. You also see that where copper equities are trading today, the producers are pricing in $5.66 copper in their stock prices, even when copper is a lot lower. That's very unusual for commodity stocks. They usually price in a much lower price, like gold stocks price in much lower gold prices. That's the generalist investor telling you that copper prices have to go higher to justify the supply adds that we need to have in the future. So there's a really nice backdrop for copper. The challenge is, where do you find value? Because if the copper stocks are pricing in $5.66 copper, it means copper's got to go beyond that to make money. I do think there's a lot of value down cap, and that's where I'm spending my time.
And this is the strange thing here is, like you said, gold mining companies are only now catching up to $2,000 gold in terms of their own valuing their own flow. Like, it's not they're not treating gold as 4,000, even though no one's expecting it to drop below 3,000 long term. So how do you square this circle of critical minerals are critical? Copper, nothing's more critical than copper to everything. It may not be the rarest, it may not be the most expensive, but it is absolutely essential to all of these applications. The long term is very, 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 very dire in terms of supply. The short term is dire enough, and so you have the companies pricing in longer copper above the value that it is. The only way you can make that work is some form of government intervention. So whether or not it's classified as a critical mineral, someone's going to have to provide a floor underneath the copper price, either the market, which hasn't necessarily done it yet, but you're going to have to provide a floor underneath that to have a 10-year, 20-year plan for a multi-billion-dollar investment in a mine. So how do you see that playing out? Obviously, we're early in this process because we're year one of the Trump administration. This whole North American integration in an environment of more national security, less economic cooperations on these guys. This is all very new. But what is the mechanism that's going to make those $6 valuations in the stock price make sense? How do you get there over the next 20 years?
Lots to unpack there. It's a multifaceted answer, but I'd say where you're seeing the U.S. doing much better than Canada right now is they're building roads. They're providing funding. They're making it easier companies to access capital. They're tightening the permanent timelines to make it faster to get to market. What comes through in Alaska. So you need to see governments can not have to put a price floor in copper, but can do a lot of things to make the projects easier to build, like infrastructure, permitting timelines, shared infrastructure, government direct investments in projects, loan guarantees. You can do that to make sure the projects get built. One question you asked about the generalist copper investors I want to come back to is, if you take 100 generalist investors in the U.S., they understand AI, right? They understand electrification of the grid. They understand electric vehicles. So they've really adopted the copper trade. So why the copper equities are trading better than the gold equities is an average generalist investor is okay owning copper equities because they really believe in the long-term price, the long-term sustainability of that trade. And it's a direct derivative of what they're already investing in, like AI.
It's upstream of exactly what they're already.
Whereas gold takes a little bit more time to understand the world has changed and gold's reasserting itself as a crucial monetary metal in the economic system again. So the generalist investors, the sticky money, they don't own gold stocks yet. And that's why the gold stocks are trading at a discount to NAV, discount to the current spot price, and the copper stocks trading at a premium. The opportunity in the gold stocks is either they're going to get there as more and more generalist investors understand that the gold market's changed. So if we talked about earlier. So I do think there's still a lot more value in the gold equities than there are in the copper equities. But that being said, there's a big push and a lot of support for the copper equities. So it is a lot easier if you're a copper developer to get the government backing and the financial backing you need to move your project forward.
And I guess that's why they can also get away with valuing copper well above spot price, and no one bats an eyelash. Yeah. Okay, now let's we're touching on mining equities, so let's get into it. So we've seen the majors obviously shoot up this year. You talked about gold producers, also silver producers, copper producers, even more so, generating enormous cash flow. So where are we in the market? This is good news. But we're always looking ahead. So how much value have we captured? How much is there for an investor at this point in the cycle? So where are we starting with the majors, where are we in the cycle as far as as equity valuation?
Yeah, I think 2 years ago we talked, I said the gold price had a lot of upside. Last year I said the equities are lagging in the gold price and the majors would be the first to rally. So the box has been ticked as well. I think the next part of the cycle is going to be the developers and the junior resource equities. It's now their turn to shine because the senior producers are making record margins. Anico reported last night another fabulous quarter, record free cash flow, record margins. So the seniors have paid off all their debt. They're buying back stock, generating record cash flow. And now you're looking at the junior producers, the junior developers and resource stocks that have had okay moves the last 6 to 12 months, but look on a 5-year rolling basis. Many of those stocks are just getting back to where they were trading when COVID, 2020 levels of, $2,000 gold price. So the majors now have much better currencies. Their stock prices are up significantly, pristine balance sheets, and massive amount of free cash flow. And they're still able to buy junior producers at valuations that are approaching the 2020 levels. So you still got a really compelling value proposition in the junior resource space. And by the way, they're in a business where the resources get depleted every single year. So you've got to replace your resources and your reserves if you want to have a viable business going forward. I think there's been a bit of an attitude from the majors that, well, I've had a chance to buy you for this price for many, many years, and all of a sudden I got to pay a little bit more, and they haven't adjusted to the reality that their stocks and businesses are way more profitable and more valuable than they were before. It hasn't quite translated yet to the junior resource stocks. What's changing too is that the junior resource market for the first time is able to finance itself. The last 6 to 9 months, the financing window started to open up for juniors, which actually makes their businesses more valuable because you can drill more, grow your resources more, advance your projects more. So that's going to put pressure on the majors as well to act sooner before these businesses start to increase dramatically in value through financing and growing the value of their business. So that's my next call for this year is developers and junior resource stocks should start to do really well and outperform the major mining companies, especially if the gold price stays flat or goes up a little bit from here. That junior resource stocks are very well positioned to outperform, and we should see a big M&A cycle into junior resource stocks ahead as soon as the gold price calms down. It's hard to do M&A when the gold price is going as quickly as it has because how do you price a deal? But I think that's another wave of catalysts you're going to see coming. A few companies getting taken over, the market will start to revalue the general equity junior market as a whole at a higher valuation level.
All right. Well, there has actually been some M&A activity, no question. You've actually had something, recent news on that front.
Yeah, Northern Superior Resources, my largest personal investment, I've been director for 6 years. Last week got acquired by IM Gold for about $375 million. So very positive sign for the junior resource sector. Strategic asset in a major mining camp in Quebec. I think we sold for about $70 US per ounce in the ground, $100 Canadian per ounce in the ground. Many companies are still trading at $15, $20, $30 per ounce Canadian. I saw a great study, Ernest, a couple of weeks ago, whereas in M&A cycles, on average, the acquisition price of a resource is 10% of the spot price. Now, there's a lot of variability in that. You're buying a company that is about to go into production and has reserves versus a company that has only inferred ounces. But on average, if you take all the acquisitions in a current cycle, it's about 10% of the spot price. If you look at the Canadian gold price today, because we're in Canada, about $5,500 Canadian per ounce. 10% of that's $550 an ounce. You're buying ounces at $100 Canadian, that still sounds like really good value to me. And many projects are trading at $20, $30 an ounce in the ground. And why can you afford to pay $500 an ounce? Well, if you're making $3,000 Canadian margins or $4,000 Canadian margins, paying $500 an ounce in the ground for something, plus your capital costs and your sustaining costs, you still got a lot of margin to work with. So the gold price has moved up, the margins are at record levels, but you can still buy the main input in your cash-making machine, which is the gold ounces at very, very low levels. So that has to start drifting up over time. And the leading companies are trying to get ahead of that and make acquisitions at the right time. We sold the company because we took the paper. We really like IM Gold stock. I think it's got a lot of upside in that stock. So it wasn't an exit. It was hitching our wagon to a really well-run company that has significant upside itself. But we're going to see more and more M&A in the space and more cash M&A. There was some cash in that deal as well, which was quite surprising. Where, 2-3 years ago, companies were trying to conserve their cash. Now they're generating record profits. You're going to see a lot of cash deals, cash in stock, or pure cash deals.
And then what else is interesting for the junior miners in this environment? You mentioned that now there's, I wouldn't necessarily say competition, but at the very least, complementary financing is available to them. They can get direct financing. They don't just have to get from a major. They can actually finance their own development and drive up their own value and then go back to the major 6 months, a year, 2 years later. And so how does this change the dynamic at a place like Xplor, where the companies are coming back, but now they have 2.5 million deals that were upsized to 3.5. They have 7 million deals that get oversubscribed. How does this change looking at it from the perspective of a junior miner, not so much from the perspective of an investor, but how does a junior miner operate intelligently in this type of an environment where now the majors are flush with cash, you have potential for financing outside of the majors, but of course you can't catch your chickens before they're hatched. You're in competition with one another. So how do you operate in this environment from looking at it from the board member of say?
So great question. So we talked in the past about one of the issues the industry has is in Canada anyway. If you and I are in business tomorrow, we have a junior mining company, we make a discovery hole, brand new discovery today, together in Quebec or Ontario. On average, the stats say that from that discovery hole till the time we're producing gold or copper or whatever, it's 25 to 30 years. And so if you build a discounted cash flow model and say, Ernest, I'm going to give you $100 million a year of cash flow from that mine, but it's in 30 years, that's worth very, very little today because of the time value of money. So two things that are happening. One, why do projects take 25 to 30 years? One is the financing window usually is closed for long periods of time. So we make our discovery, but we have no money to move the project forward for years on end because we're doing $2 million at a time. So it's very, very slow. And two, the permitting timelines are atrocious in Canada. Years and years and years of review, which even if you have the money, you're still stuck for 5 to 7 years getting all your permits and approvals to build the project. So how do you increase the value of the mining company? If the financing is available, then you can push your project as fast as you can to that window, dramatically shortening the time to production. And the second thing that's happening in the US, and I pray that it starts to happen in Canada, so far it's all talk in Canada, but they're actually doing it in the US, is government either getting out of the way or government being much more supportive of projects to compress that timeline. So instead of 25 years, it could be 10 to 12. If you do that, the value of a junior mining company dramatically increases and the investor interest increases because they know if I invest in you today, that mine could be in production while I'm still alive. It's a short enough timeline that it makes sense and the cash flow dramatically increases. So financing window will move projects much faster. So Asset Mining's company I'm involved in, we've gone from doing $5 million financings as a director to doing a $25 million bought deal, doing a 10,000 meter drill program to a 140,000 meter drill program. That's going to dramatically accelerate the speed of which that project comes to market and becomes a producing mine. Now, the second step will be, let's make sure we're not stuck in 5 to 10 years of permitting timeline. Can we collapse that to 2 or 3 years? Still do a good job for the environment, still do the right things, but collapse that. Those two things come together, that's how we're going to have a dramatic impact on the industry. So I'm seeing financings, I'm seeing in the US positive signs, I'm hearing positive talk in Canada. We get all those things together, we can really start to create a lot of wealth in this country.
That's an interesting point as well, is that this comes back to the idea of the critical minerals, or just the overarching narrative about these metals has shifted to being national security, national interest, long-term nation building and strength of countries. So do you see this as, this is something I've been trying to get a handle on, is on the one hand, Canada's a sovereign nation, Canada sets its own policy, but on the other hand, everybody understands that Canada as an economy, and especially the resource sector, feeds directly into the United States. So if you get the U.S. building processing facilities on, say, military-owned land, or if you get the U.S. speeding up permitting, if you get all of these things happening in the U.S., then it puts economic pressure on Canada to supply. It puts pressure on Canada's policy framework to stay aligned with the United States. So do you see that as something that to watch over, say, the next few years? Is Canada, on the one hand, is going to maintain its standards and its priorities and its way of doing business, but we're always needing to move, not necessarily in lockstep with the U.S., but we definitely need to move in relation to the U.S. So this is the kind of thing where no matter what the Canadian government says today, what the whole industry is going to need to do is remain aligned with the United States in terms of timelines.
I think we have, Ernest, I don't want to get too political here, we have a generational opportunity. And as a Canadian, I'm very disappointed in the last 10 years that we're watching that ship sail and we're not getting on that ship. Canada has 41 million population. Saudi Arabia has 37 million population. We have more mineral wealth and resource wealth in this country than Saudi Arabia. We should and could be, I'm Canadian, one of the richest countries on earth. But due to policy or lack of focus or just general malaise in this country, we're not developing the resources that we have. We also have a bit of a strained relationship with the U.S. government right now, which everybody knows. The most important card we can play in those negotiations is the sustainable and rapid development of our natural resource sector. Our number one trading partner is going all around the world, giving $1 billion to Australia on a critical metals deal, when we're right on their border and have oodles of these critical metals at their disposal. Why are we not capturing that advantage? We have the manpower, the knowledge, the education, the industry background to rapidly develop these resources. We're at a conference full of trades and engineers and mining professionals that could easily build these resources. So I think as a country, we got to get really, really serious really, really quickly at a period of time where demand for resources has never been higher. The pricing has never been better. So from a geopolitical perspective, from a trade perspective, from a wealth creation perspective, this is a generational opportunity in Canada, and we have to grab it. This is will help us on so many levels. And thus far, we've been really sitting on the sidelines, and we have the best geological advantage of any country in the world to do this. And so I really hope that we start to see some real concrete action, not just because I'm an investor in the space, but as a Canadian taxpayer and as a citizen. This is an incredible opportunity for our country to really jump on a 20-year mega theme that we could really be leaders in and real drive the discussion rather than be on the sidelines complaining about it.
All right. Well, it sounds like we have a lot to watch in the metals, a lot to watch in the equities, and also a lot to watch on the geopolitical front.
It'll be exciting times.
We'll have to circle back with you before next year for sure.
Absolutely.
Our coverage from Xplor 2025 in Montreal continues right here. I'm Ernest Hoffman for Kitco Mining. Subscribe to our YouTube channel and don't miss any of our updates.
Kitco Mining special coverage of Xplor is brought to you by Radisson Mining.